right, healthcare was a laggard on the S&P 500 when you track it against 2023 performance. It actually underperformed by the most in 30 years. Our next guest believes that in 2024, this sector is projected to lead the S&P in earnings growth. We'll talk about whether that means we'll see stock market outperformance. We've got Rob Moffat, Portfolio Manager at Middlefield Group. Thanks so much for being with me.
Thanks for having me.
So there was this little pocket of healthcare that did super well, and that was the diet drugs, the obesity drugs, and then everything else was just kind of left by the wayside.
Pretty much. Yep.
What do you think is the catalyst for a turnaround in 24?
So I think the reason that healthcare underperformed so much in 2023 is, the story as it usually is, was earnings. So a lot of healthcare companies really benefited from the tailwinds related to the pandemic in 2020 and 21. You could argue that they perhaps over-earned during those years. And then in 22 and 23, once the pandemic started to subside, they were basically comparing themselves to much more difficult comparisons, and the sector actually had negative earnings growth last year as a whole. So
as you look for opportunities, there's a lot of ways to slice it. There's equipment, there's early stage biotech, there's more established players. What slice are you looking at?
Yeah, so one of my favorite areas going into 24 is the life science tools and services sub-industry. So,
okay, specific.
Yeah, it's a long name, but so it is about 10% of the sector, so it's pretty material. And basically, life science tools and service companies, they sell products and services that are used in labs. Often that's used for R&D or clinical research. Diagnostics is a big area for them. But they probably felt the dynamics from the pandemic more than anybody. They had a lot of increased capacity for vaccine manufacturing. There's a lot of money being spent on R&D to figure out how to treat COVID. And they also had testing tailwinds. They had PCR testing, and the rapid antigen tests were big tailwinds for them. So they're really coming into, they felt that earnings decline last year, and I think that this year they should inflect higher again.
All right, so I found, I found that index, and you're right, since the lows of October, it's up nearly 30% as a sector. Let's go through some of the specific names you're picking. Thermo Fisher is the first.
Yeah, so Thermo is basically the bellwether of the sector, the industry leader. If someone were to look for kind of basic exposure to life science tools and diagnostics, this would probably be the first stock to look to. They're a large global player, over 400,000 customers worldwide. And what's interesting about Thermo that I really like is that over recent years, they've transitioned their business to focus less on the typical chemicals, reagents, and instruments, which a lot of their peers focus on, and more towards the service side of the business. And that typically lends itself to more biopharma customers, higher degree of recurring revenue. And that's kind of a differentiator that I like for Thermo.
So sales fell in 23. They're poised to just kind of be flat for 2024, according to consensus estimates. Do you think there's some upside there, or do you think that's enough to?
I definitely do think there's some upside to that. I think consensus is probably a little bit below what Thermo is going to deliver next year. And then if you look outer years into 25 and 26, this is typically a mid to high single-digit top-line grower, double-digit earnings growth. I think that Thermo gets back on track onto that trajectory after 24. 24 is probably back to normal, and then 25 is off to the races.
Is the similar story with Danaher, your second pick?
Yeah, so Danaher is, if Thermo's the bellwether, then Danaher is a very close second. These two companies are often compared to one another, and they are very similar. They compete with one another. They go after the same customers. What's differentiated about Danaher is that they, in recent years, have made some transformative acquisitions to invest in bioprocessing. So basically, bioprocessing is the large-scale manufacture of biological drugs or the use of biologics to create products. It's very much commonly used in what I would call the next generation of drugs that we're seeing come to market, the GLP-1 drugs, for example, Alzheimer's drugs, vaccines, et cetera. So
these aren't value names, though. Aren't they too expensive?
Well, Thermo's trading about 24 times forward earnings, which is actually right in line with its 5-year average. So I wouldn't say that Thermo is expensive. Danaher is a little more towards the upper range. But I think that the reason Danaher is a little more expensive is that the bioprocessing recovery has a little bit more visibility. We definitely can see order books picking back up in 24 after a full year of the phone not ringing, really inventories being destocked in their customer base. Now I think that orders pick back up again.
Your third pick is interesting, Becton Dickinson. It's cheaper. Looks like it had a bit of a fall off in November when I'm looking at the chart. What happened there?
That was basically an earnings story. They actually hit their earnings of that quarter, their fourth fiscal quarter. But there was some guidance with relation to China, some FX concerns that kind of came out of nowhere, were a little unexpected. So I think a short-term issue, definitely a great opportunity to buy a very high-quality defensive stock on a pullback. And the interesting thing about Becton, so it's technically not in the life science tools sub-industry.
Now that I know about that index, I know that it's not in there.
Yeah, so it is, it's in the med tech, it's a med tech stock, healthcare equipment. But what's often overlooked is that 30% of Becton's revenue comes from its life science segment. So unlike Danaher and Thermo, which are typically going after the biopharma customers, they're more in the R&D, the clinical setting. Becton's business is a little bit more of a clinical setting. So their biggest customers would be hospitals. They're a major player in blood transfusion and analysis and collection. So their customers are a little bit more, call it government, if you will, and they're very stable and defensive.